The Hedgeless Horseman here. It's September 7th, 2022. The stormy markets continue. We saw pretty big reversals in the US stock markets and commodities as well. Silver was actually up around, I think, 2% during the night, and I think it actually ended down. So, yeah, again, wild swings. I mean, there's something. Some bad headline out every other hour or day, it feels like. And the dollar simply continues to rip. So the paper prices of gold and silver in dollar terms, US dollar terms, have been having a tough time pretty much. But I mean, in most other currencies, I think gold, especially gold, is close to all-time high. I wouldn't be surprised if the same thing was in silver, which kind of again highlights the fact that physical gold and silver, for starters, is like that's priority number one. I mean, yes, I own a lot of mining shares focused on gold and silver, but they are a completely different beast relative to physical gold and silver. I mean, I see miners as risk. I mean, that's risk on. Gold and silver, physical forms, like the most risk off stuff you could hold. So I see them as hedges against each other actually, because I mean in my currency, the Swedish krona, physical gold is around the all-time highs. So my purchasing power from physical gold and silver. Has worked out well. And I can't say the same for people with, Swedish kroner in their bank accounts, obviously. But again, in the in US terms, gold and silver has had a lot of headwinds simply due to the strengthening US dollar, which has pushed down a lot of commodity stocks, miners, etc. Interesting. The interesting part is I think the Canadian dollar has strengthened like 30% or so against the Swedish krona in the last, I would say, last year or so. So in Swedish kroner, my portfolio would have done a lot worse in the last year if it wasn't for the favorable the strengthening of the Canadian dollar versus the Swedish krona. So again, obviously one would have hoped perhaps, I mean, depending on time horizon, I mean, again, it's hard to have very good future returns if we're not able to buy low, cheap. So I mean, you wouldn't want an ever rising market really if you want to make big money. Especially if you don't use leverage at least. You really want these flush outs. And I mean, lately we've seen some big flushes in the juniors. I mean, I took a look at my two sentiment proxies, which is one is Strategic Metals, ticker SMD.V. It's a Canadian prospect generator. It has like 100 projects, 11 royalties, shares in other companies, yada yada. So it's like dirt cheap based on the sum of its parts. I mean, I don't think they have a lot of like world class projects, but it's like still I think around 100 projects, and I actually think last time I looked, the market cap was less than the I think it was less than the cash in the bank and their equity portfolio. So you got like 11 royalties and 100 projects for free. So obviously that's like super cheap because no potential, no risk appetite at all is priced in for any of the projects. So they're pricing in a zero chance of anything ever happening for their projects or monetizing a single one of them, etc., and no exploration potential, obviously. So I still find it to be a pretty good proxy for sentiment, because it kind of shows just how extremely risk off, how extremely poor the sentiment is in the junior space. And you can see strategic metals is almost back to the level it was in July, where it hit around 22 cents. So this is below the COVID flash crash, where miners dropped like 50%, maybe more actually. I mean, from the peak here, yeah, 56%. So we're lower than that. We're lower than the major bottom in 2019. Strategic metals is actually lower than the bear market bottom in 2015-16. So that's kind of interesting, and of course one has to account with for dilution, etc. Because there might be a company that has diluted, printed a lot of shares, etc. So even if it gets back to this level, it might be, actually more richly valued, or less cheap, let's say, even though it might actually even be below this level. But in the case of strategic metals, for example, I think they recently did actually a small raise, but you can still look at the face value of the company relative to their cash, equity holdings, etc. So it's hands down cheap. So even if the share count has been a bit or bloated a bit from this point, I think it still is a sign that sentiment is atrociously bad. And here you can see the global financial low. I mean, this was a real rinser of a move. I mean, this is total liquidity crunch. So I'm seeing people, I see a lot of gold bugs, silver bugs, etc., throwing in the towel, walking away, expecting a crash in the broader stock markets, and that should take the miners down, etc., etc. They might very well be right, but the fact remains that if you're a market timer, you're a market timer. That's extremely hard, in my opinion. Because there's a bunch of false starts like this. I mean, this looked like a bottom. So I mean, if you're wrong about that, or I mean, let's say this looked like an accelerating trend or whatever. So you were buying here actually, and then it's chop down 50% or whatever. And same here, you bought because you thought it, I don't know, broke out. This was higher than this, so you buy here and then chop 50% down. Maybe you sell here because now you're again waiting for the trend to change. So I just think that's a very hard thing to do. And perhaps more importantly, I mean, some of these bottoms, when it actually bottoms, it's not typically you're gonna have a lot of time to get a full position. And second of all, how would you know when the trend has changed? I mean, let's say you sold out here, for example, in strategic metals, and you were waiting for the trend to change, for example. Okay, so you're seeing it go down. You feel pretty smart about it. Then it goes down to 24 cents here. And then it breaks, let's say you make a trend line here or whatever, and it closes higher. So yeah, you buy here, for example. And this time is unlike this one. This is not a false start. And of course you can't possibly know that beforehand. You'll see that afterwards, which again makes it so goddamn hard to time the market or be a trader, in my opinion. But anyway, but let's say you bought down here instead. I mean, you would already, sure, you missed the move down or whatever. But it's if you just kept on buying and lowering your average cost, for lack of a better word, maybe you bought quite a bit. So let's say let's say you grab some down here, but you grab, shares all the way and all the way through and here as well. So you might have an average of like 30 cents or whatever. No market timing at all. So even if this guy who's waiting for the trend to change, who is like, yeah, okay, super disciplined, I believe this is it, and he was lucky that this was actually it, but okay, you're up 20% already on him. 20% is not a small return. But of course it's gonna feel like that right now, for example, where a bunch of stocks are down like 50-60% and it feels like, well, I need 100% return just to break even or whatever. But it's like when these moves get going, even in a boring prospect generator, especially off the bottoms, I mean, that's like 260%. I don't know how much it did in, I mean, when it went from the bottom to the peak here, must have been, Jesus, okay. So it's like panic bottom, yeah, over 3,000%. So it's like, when you think about it, how good of a timing would you need to have? I mean, even if you bought the top in 2007, I mean, 100% over 2007, let's say 3 years. That's still a really good return. But most people, of course, I mean, that's what people expect. I mean, we're kind of intuitively or impulsively looking for a stock that's, gonna do 100% in the next month. I mean, why else would people be so obsessed with, yeah, me included? It's like we write in the forums every day or we comment on Twitter every day. I mean, that's not really patience. But when you're actually very objective about it, 100% in 3 years is an absolutely great return. If you could compound 100% every 3 years, you're gonna make a lot of money over time. With that said, of course, when these juniors tend to bottom, they go up way more than 100% from the bottom. So that's why I keep on saying that I think the costless mistakes one can do, especially in a very sentiment-driven market, is to buy low, because some of the rallies are absolutely extreme, and the longer these lows continues or they get cheaper and cheaper, it's gonna suck and suck. I mean, your paper losses are gonna start mounting up quickly. But if you just average down, etc., and let's say you are diversified and all of that, so you actually, I mean, the thing about diversification is that, okay, if you're diversified here, you're for sure gonna take the full brunt of it because the whole sector is trending down. But the same goes obviously in the opposite direction. If you're diversified near the lows, you can be pretty sure that you're gonna catch the next rise as well. So I mean, this was more of, I guess, an event. I mean, it didn't stay down here for too long. This was certainly an event. I mean, if you just snoozed through this, I mean, let's say you saw this unfolding. It's like, yeah, everyone's hair is on fire, everybody's screaming and running for the hills, etc. It was like within, I don't know how short this was. I think it was just a few months, and it was already up like 200%. But even after like, I don't know, a month, like 4 weeks, up 60, and this is a boring stock. I mean, the big beta plays, they did way bigger rips than strategic metals. And again, when you think about it, it's like, because people always feel stupid if they're sitting on a paper loss for a long time. I mean, let's say you bought here, and then you sat through 2-3 years of downtrending action. In 2016, so yeah, let's say 3 years. I mean, you would still be up again, close to 100%, and you would still be 3 years early and have 100% return over that time period, which I think beats absolutely most people. Seriously, I mean, most people don't beat an index. 95% don't beat an index, And an index does not pull 100% returns in 3 years typically. So those would also be stellar results. Absolute stellar results, 100% in 3 years. You would dream about being able to compound like that. But the journey there is almost nobody can suffer through that. And of course, how would you make even more? Obviously by buying ever lower, sucking it up and buying ever lower, because your average cost would go down, so your future returns go up, and you have a bigger stake. Obviously you get more shares, etc. You get more assets for your dollars the lower it goes. I mean, you're supercharging your future returns by buying ever lower. And again, I have no idea, which I've said many times, I have no idea how low the juniors can go. I mean, if we just look at strategic metals, it's like 41% or something down to even more. Yeah, okay, yeah, even a bit more. Let's say it could drop 42%. So let's say you're already down, I don't know. I mean, just from this stock, depending on when you bought it, obviously. I mean, if we talk about from the top, that's down 83%, which is pretty horrific. But typically, you're not going to be down 83% on everything. You haven't, you didn't top tick every single purchase you made. That's not really what kills people. It's in my opinion, the trading and trying to time, like, buying here, selling here, and then buying here and selling here. That's the stuff that I think grinds people's returns to, zero over time. It's the constant effort to try and time the market, to be right on every move, to not have a down year, less alone, or not a down month, less alone a year. But I for example, I've sat through this whole correction, and that's over, I think, 2 years. And it might still not be over, but I don't care. I know this is extremely low, and I know it can go even lower, and I hope I have some dry powder then to just buy and buy and buy. Because what typically happens, I mean, the saying, the bear markets are the authors of the bull market. So I mean, if this fat crash led to the global financial, this was the global financial crisis. So it took everything down. And what happened afterwards? I mean, again, strategic metals, they probably, I don't know, but I'm assuming they made some type of discovery. So this was like probably supercharged. But if you go from extreme pessimism to extreme optimism, given the policy response, etc., because we first had the big flush in gold and then the epic 3-year rally. So I mean, when you think about it, it's like the worse things get, the bigger the rally for precious metals that will come after. So that should get you kind of greedy. It's like it's this we're after. It's the big moves after something has sucked big time that we're after. And the more it has sucked, the better it's gonna get. I mean, on that note, here's an article from Reuters. Push to shorten US mine permit review process gains steam. US mining companies, automakers, and bipartisan group of congressional members are recommending that the federal government cut the time needed to permit a new mine in order to boost domestic production of electrical vehicle minerals. The request, blah, blah, blah. Okay, sure, this is for, green metals. But still, the picture, or the fact remains, this sector has sucked. And a big part of that is because it's so goddamn hard to get supply online. So what's going to happen to price in that case? I mean, we're seeing lithium take off. We saw the the nickel squeeze. It went up, I don't know, 300% in a week or something, broke the market. We read about the oil market not functioning. And like some clues lately, COMEX registered silver drops to under 50 million ounces. I think it's actually down to 48 million ounces now. Last time I checked today, this fella here. Yeah, COMEX withdrawals continue. For gold, registered silver vaults drop to under 48 million. And I read also on Twitter that 5% of the registered category in platinum was withdrawn. 5%. That it looks to be some kind of, there's a run on physical. There's a strengthening trend, it appears like. So I mean, what does that tell you? I mean, people are trying to hoard the physical stuff, and we have again, it's like a push to bring more supply online because they know that there's a supply shortage. So it's like I think we're sitting on the winning hand here with commodities overall. And given that all of this crap, including a rising lithium price, energy price, copper price, yada yada yada, that's not too good for a global economy with the amount of debt we have. So it's like the better the base metals and energy etc. do, the harder it is for the consumers, obviously, because inflation is crunching everyone's purchasing power, which would in time lead to a policy response and probably printing of money where gold and silver would shine. So it's like, yes, gold and silver are not ripping now because I think we're still in the flush period of the liquidity crunch, financial crash stuff, and it could drop 50% from here, your juniors. Still, what comes after that might be biblical. So the worse things get, the closer we obviously get to some kind of policy response or something breaking. And we're already see the rush for, physical. We're seeing COMEX being drained at a steady pace in gold, silver, and platinum, and nickel inventories are low. Everything is pretty much low. So it's like, what would you rather own right now than that stuff? And sure, I mean, copper, etc., which are consumed, and nickel and oil. That's great because that's not just hoarded like gold. But at the same time, when shit is hitting the fan and there will be some kind of policy response or the system will just blow up, I mean, I'm expecting they reset it in some way, maybe with, digital dollars or whatever. Regardless, that's when the monetary metals will shine because demand might get totally crushed, which we're pretty much seeing. I think Goldman Sachs wrote that the oil price was reflecting a 2008-9 type scenario. So it's like, okay, in that case, I mean, demand is already being crushed. So yeah, I mean, again, I think it's important to remember, it's like gold and silver is not the first one to take off. I mean, they'll do everything to save the system, obviously, and they've been successful a lot of times before. And again, it's like there's a big difference between physical gold, silver, and mining stocks. But it's like, what can I foresee happening? Okay, they're draining the COMEX kinda right now. And let's say this gets worse and worse, etc. I mean, the masses are nowhere near gold and silver. I mean, gold and silver bugs are throwing in the towel. So when we actually have a big rush, or I mean, I don't know if I would call it a big rush, but it's like 5% of population starts to appreciating gold and silver, whatnot. I mean, the supply might go like that. So the question is, okay, let's say you can't even get a bar of silver or coins of gold or silver, etc. What's the option left? I mean, you kind of have to go into the... First of all, I think prices will obviously be rising in that case. But how do you get exposure to gold and silver and other metals if there's nothing to buy? I mean, you have to buy it in the ground or a producing asset or something like that. So that's what I think. I mean, the fear of need, which I've shown in my other sentiment charts, that's, I think, could come in the real end game. That that the rise in, let's say, miners, it's not just going to be greed, it's going to be the fear of need, which I think is going to be stronger than greed, actually. I mean, this was, I think 2011 was like both things, because we had the problems with Greece, we had a down rating of the US national debt by S&P, I think. And again, we had the European crisis. So gold went on an absolute tear, and then they kind of managed that. We had the Draghi speech. I'll do whatever it takes, and it will be enough. Yada yada yada. And then we had a fat bear market. So we had euphoric times leading to the biggest bear market ever, pretty much. And now we're having very depressed conditions again. So which will be followed by a big bull. I mean that's just pretty much how it is. And right now, I mean, I think the headlines are like increasingly bad for the world economy. Anyway, I hope you get my point. And it's like Bear Creek Mining, which is very high beta stock, I think proves it even more. I mean, imagine, well, from the lows here, I mean, it went up I think it ended up like 2,600%. Anyway, let's see, you got into it here, Great Bear. And you started down like 82 goddamn percent. Man, would you feel stupid, like a total idiot. And you didn't buy anything more, but you didn't sell on the way down, okay? Yes, okay, this was 2008, and here's 1 year later, you would still be up 50%. Let's say 2 years later, you would be closing in on 100%. From buying here and being down 82%. And everybody's going to call you names and how shitty of an investor you are. You didn't sell. And you see it crashing. So you bought for like 10,000 here. You have, how much was it? 10,000. Your portfolio goes down to, let's say 1,600 is left of your portfolio. Yeah, okay. After that, you still hold on, and then your portfolio is worth 15,000 all of a sudden. On the ways to climbing to 20, 30,000. I hope you get my point. That it's like buying cheap and it gets cheaper. It's not I'm not advocating for Bear Creek Mining, by the way. I'm just using this as a proxy. It's like, yeah, this was a mistake to buy. If you sold here or here or here or here or here or here and didn't buy back lower, which is kind of hard to do if you're selling here. I mean, let's be honest. So it's like the only way I can make sure that I don't miss the low is by never selling when it's cheap. That's the only way I can make sure that I'm gonna be 100% long from whenever the bottom is. It's simply to like, past the point of selling. It's too cheap. It's way too cheap. Now is not a time for, market time. And again, here you can see examples. Like, I mean, how many false starts if you were trying to trade this? Well, now it looks good. Okay, now it broke. Okay, I lost money there. Okay, sure. And then maybe this was a higher high. So you're like, yeah, okay, I'm buying in now because the coast is clear again. And I think this was the low actually. So I'm buying here, and then bam, you're down. I don't know. Yeah, you're down like 40% in not too long of a time. But it's like, yeah, okay, I just and you sold, so you cemented a 40% loss. But then you wait, and this time, yeah, okay, I'm gonna make very sure that this actually was the bottom. Wow, what a move! I mean, look at that strength. Oh Jesus, it's running. I'm missing out. I mean, this was for sure the bottom. So you're buying somewhere up here, and then just a few weeks or months later, it's like, yeah, 70% more. And then you sell because, oh, that wasn't the bottom. And you would have been right then that this wasn't actually the bottom, and then you see this and you're like, oh, okay, I'm so great or whatever, and then you're probably never gonna buy a mining stock ever again, even though it goes up like this, because you've been punished so hard. I mean, you this took 40% of your capital, and then you 70% more, whatever, depending on where you have your stop loss. If you have a stop loss. But it's like, how many do you think are that disciplined? I don't think many are that disciplined. Compare that to just your average value investor, let's say. So okay, the lower it goes, he's buying more here than he did up here. He's buying more here than here, more here than here, a lot more than up here, increasingly much down here. So if he started buying in here and just bought as low as possible, I mean, every goddamn flush was like a gift. Nice, I can buy almost twice the amount of ounces in the ground than when I started off. Okay. So let's say you started off here, but you actually bought all the way down. And let's just say you weren't too extreme, but you managed to like lower your average to here, even though you bought all the way here, but you bought a lot higher. I mean, obviously, the lower you were able to buy, I mean, the lower your cost would have been. It would just, again, supercharge your future returns. I mean, the more blood it looked, the more you would have bought. And sure, it's gonna suck. I mean, that's one thing also, I think. It's like, let's say you bought this low, okay? And you started buying here. But you bought more here. So when it gets back here, you're actually in the green somewhat. But then it goes down, I don't know, 25%. Then you might like, oh, okay, that didn't work out. I should have sold up here, whatever. I should have took the profits, because now we're back again. Oh, but you sit along, it's like, okay, up here it's like, nice, okay, now I'm in the green again, and then bam, down here. So you're like, getting increasingly frustrated, like, oh, I should have taken profits here and here, oh my god, I'm such a fool, next time I'm gonna take profits. So it's like, oh, okay, you sell here, for example, and maybe you get out with a small, I don't know, plus or whatever. But then again, this comes along and you're like, oh Jesus, I shouldn't have sold. What did I do? I mean, these were just false starts. This is the real deal. So now I'm buying in them, slam. Versus if you just would have like sucked up every volatile thing, maybe you would actually have taken profits here. But it's like, as long as you know what you're doing, as long as you can see, okay, is this cheap or is this expensive? Is it getting more expensive? Obviously the future returns are going lower. If it's getting cheaper, obviously the future returns are going higher. So I mean, if you would have just been an absolute value hound these last 15 years in Great Bear, and you just lightened up a bit when it gets to this level or whatever, but like increasingly so buying low. I mean, if you put in some fat orders here, that's like I mean, yeah, 300, 400, 500, 600, yeah, almost 700%. So I mean, imagine if you just topped up, if you started buying here, but you topped up 5% down here, whatever. That would be good. But the point remains also that if you got in here and you just waited, you took a 80% beating or whatever it would have been, almost 80%, and just waited for the next sentiment high, you would be up 81% for 3 years, and that's really not bad. And again, how do you boost that even further? Just lowering your costs. I mean, you can see, I mean, these are not small percentages. Again, the stock market averages 8% per year, so you can see how quickly this starts to add up. I mean, if you just lower your cost basis a bit, you don't need perfection. That's why it's like, why on earth would I start to market time here? If that's not looking for perfection, I don't know what is. I mean, who cares if I buy here or here? Would you complain if you just got like 465%? Oh, yeah, just 460%. Down here would be 1,000. I mean, yeah, okay, you would look at it if you didn't have dry powder and you dropped here, like, oh, I missed 1,000. Yeah, but you still got like 400 or whatever. So like perfection is totally overrated. Just buying when it's blood in the streets, and even if you do that with like horrible timing, if you just keep on doing that honestly, and holding out, it's like, which I said before. I mean, every additional week of down action, by definition, gets us closer to the up action. So this low is closer to the next top, obviously, than this, and this was closer than this, and closer than this, yada yada yada. So this was obviously closer to this top than here, for example. So if we account for the time value of money without knowing when it's going to turn, you're still getting not only higher returns by buying lower, you're also getting quicker returns, which adds up to, the perfect storm for compounding. Interesting things like in silver, commercials are apparently net long for like the third time since, I don't know, I think someone wrote something about 1980. I'm not 100% sure, but these are approximately the two other times the commercials were net long. If that's not a pretty encouraging sign, I don't know what is. It's like, this is again, that's an extreme in this case in terms of positioning. This obviously was, sure, it might. I mean, it traded sideways, so it was still. It's not like perfect timing, but it's like if you bought here, you wouldn't be complaining. You wouldn't even be complaining now if you bought this one. You wouldn't even be complaining here now if you bought this one either. And this was obviously the flash crash. But that doesn't mean it can't go lower. I mean, yes, this was low, etc. It went up and then crashed low, and they weren't even net long here. But it's like, and I think it's the same I think in copper the commercials are quite long, maybe platinum too. But fact of the matter is, it appears that the so-called smart money are getting longer commodities. Just another slide I put together just to. I should talk more about this. I'll do that in another video. But we have, again, it's like the trading sardine, the beta. You can make a lot of money, not with timing per se. I mean, it helps. So it's like now, for example, my main focus is alpha. My main focus are the probable growers with a long runway for growth. But there will always be beta. So I mean, again, I've said it's a bunch of times. You could see that in Great Bear, etc. It's still traded down with the market and up with the market. It's just that the highs were higher. So you didn't need to trade that, and you actually got paid to wait. Whereas Great Bear goes basically up and down, up and down. The growers at least go higher highs, higher lows, higher highs, higher lows, etc. But if there was a time to, start looking at beta, etc., that's probably around this time right now. I mean, historically, there are not many cases where juniors are cheaper than they are now. And this is also a point I probably should do another video about. I just want to point it out, like, when you think about, okay, what kind of returns would you want? How long would it take? What are your expectations? I mean, in the left part of this picture, we have more of a, let's say, value play, in a sense that you might be buying something that's quite advanced, etc., has some potential for growth or de-risking, etc. And it's cheap based on what the value is now, but it's not a quick grower. It can't add value, the intrinsic value, too quickly. But you're buying this right now at a fat discount. So we don't know when it's going to catch up to the value trend, but you get this, and it's like, hopefully, it can grow a bit. So maybe we reach a sentiment high here, so you have this kind of difference, for example, or this kind of profit. If it would be a pure trading sardine, this value trend would obviously be flat or even down if you account for dilution. Still, I mean, I guess I'm trying to show the future returns are kind of fixed, but here you're pretty much buying it at a discount, cheap, whereas this is a high growth, high octane growth stock. And you can see that, I mean, there's talk about that in like, take Snowline Gold, Western Alaska, and some other stuff. There's always people in there like, yeah, it's overvalued, based on what is confirmed. But that's how growth stocks are. I mean, that's the same for regular companies. They trade at very high PEs because the implied assumption is that value is gonna increase so quickly that even if you overpaid for what they have at face value today, what they have confirmed, if you just hold it long enough, with time, the value is going to go up so much that, I mean, the longer you wait in this case, if the value trend is like this, yes, you overpaid today based on what is known, but what is known in 2 years is going to be worth this much. So from here to here, that's your profit in this case. So I mean, it's a bit different than the pure like value play where you buy confirmed success for, on the cheap, etc. But it's like those are two acceptable ways to go about it. And obviously, I mean, if a value trend could continue, a high grower could continue to grow for quite some time. I mean, that might be a very rapid pace in value creation. So your returns are gonna, obviously, I mean, you get paid to wait in that case, whereas if it was just a fixed trading sardine, time actually works against you and you still have a fixed, price to value gap, pretty much, which might actually be downsloping because there's dilution, etc. So that doesn't really help you, because if it takes a very long time for sentiment to return, even though it's like we showed in Great Bear, you could wait 3 years and it would still have been worth it actually, which is a lot longer than almost anyone can even, see themselves being in a sector that's, quote, not performing or, quote, not working. Even though if you did that, if you had that kind of patience, you would mop the floor with like 95% of people. But anyway, you don't get paid to wait really. You have a fixed intrinsic return, let's say, return profile. But in worst case, it's actually going down. So the longer it takes, let's say the value trend was actually down here due to dilution. So in 2 years you make this much, but like if it took just 1 year, you would have made this much, for example. Whereas in a high octane growth case, the more time passes, your intrinsic value and implied profit is just going up and up and up with time. So then timing becomes less of an issue, while accounting for the fact that it will for sure not be a straight way up. You will still have sentiment highs and lows, etc. Anyway, lastly, just some comments about micro caps. I mean, you see look at these charts here. I mean, they're kind of, well, yeah. I mean, they're similar stuff basically. I mean, if you just looked at it, it's like, okay, I guess all the companies have, done the same. Their profits are down or whatever if this was a regular company. No, this is what sentiment does. This is this action. This affects every single junior pretty much. And I'm starting to look in, I mean, I'm starting to look into micro cappers because I know that some can sneeze at this. I mean, look at inflection. It's down 31.6% today on 32,000 shares traded. That's like 4.8 thousand Canadian dollars that produced a 31.6% swing. And it has been, it has doubled from the low here, more than doubled, up like, I don't know, 100, what is that? Yeah, let's say 150% in a month. You won't see that stuff in Barrick or Franco Nevada or whatever, that someone starts buying a bit and it's like, yeah, okay, up 150% in a day or down 31% in a day. I meant up 150% in a month and down 31% in a day. But look at the volumes. I mean, when this sector turns, many microcappers, without doing anything really, will be up 400-500%. I mean, if you just look at some of this, okay, it's trading at 3 cents now. E2 Gold peaked at 30 cents. So that's a 10 bagger. Not much has changed. Well, they've drilled actually. Maybe it actually, I don't know, was a bit overvalued here. I don't know. But it's like, I'm increasingly, I mean, I personally think you could do, if you picked 30 decent microcap companies and just put in stink bids at sub 5 million, etc. When this sector turns, I think you're gonna make a lot of money. But that's not my preferred way to go about it now. But it's like I do pick up some microcappers because I have seen countless times what happens when these turn. I mean, this was like 200% quite easily, and this was within a few months. But I guess what I'm trying to show is like sentiment is so poor and liquidity is so low that when there's even a hint of some buying returning, and we have to get past, I should say that we're soon into tax loss selling as well. So I mean, sure, you can be, you do whatever you want, but I think if you put in stink bids in some of these micro cappers, and I'm not saying go all in on micro cappers or anything like that, but it's like if you get 30%, if somebody's just market sells 30%, I mean, this, if somebody would take a decent size, I don't know, tax loss selling profits in inflection, 4.8k of selling produced a 31.6% washout. So imagine if someone has 100,000 in a stock, in a micro capper. We might get the most absurd deals ever in this sector over the next few months. Let's say we get a total market crash and tax loss selling. I think if that happens and we get some micro cappers that from these levels, after already been down like, I don't know, 60, 70, 80%, if they go down like 40% more or whatever, I think they're going to produce 1,000% returns easily when we get to what comes after the flush. But I wouldn't be plowing in, have my whole portfolio in micro cappers. It's just that we're getting to such extreme levels that beta and the speculative part, which is the micro cappers, they're getting so cheap that just from the sentiment swing alone, I think they're gonna be multi-baggers, big multi-baggers. It's like Idaho Champion. I haven't done much in the last year or so, and yeah, like I just checked this out today. This was 1st September. So like, yeah, from bottom here, 3 cents up to 5 cents. It's up 5 cents now. That's a 50. What is that? 50%? More than 50%. That's a 66% swing in a day. How long do you think? How easy will it be for Barrick to pull a 66% return? Certainly not from some guy sneezing with like 11k worth of stock purchases. So just be aware that, I mean, crisis and opportunity are very much, two sides of the same coin. But obviously 90+% of people are looking to sell right now, or have sold, or are gonna sell if it goes lower. And I'm gonna be there and rip the eyes out of their selling, um, if you know what I mean. Uh, but again, primary priority number one is to have physical gold and silver and all that. Because if this turns into an even bigger flush, you don't need to have a massive amount of money at risk, and still you could get really, really good returns. If we go down to, yeah, I mean, here, that's like, I mean, again, if we go into a real, something really spectacular happening afterwards, who knows where the limit is. But some units might not make it, etc. So I think if you don't not sure what you're doing, I think buy companies with cash, especially the ones who have good access to capital as well. That's why I personally like Crescat plays, for example, because they always seem to, especially if it's a the store is intact, they seem to be willing to put in more money. That's a very good thing, obviously, because it makes it less probable that they will go bankrupt. Uh, yeah, a big rant, long rant as always, I guess. But I think it's it provides some kind of value to people who are really not accustomed to a flush like this, or have never really bought a bottom or held off uh, or held on long enough to reach a top, or whatever the reason might be. Because I see people raising cash all the time lately on Twitter. And I mean, everyone should do what they're comfortable with. I'm just saying what I mean. I don't try to get emotions to really play a part. I mean, in poker, that's what got you killed. You always had to do the most rational thing to maximize your long-term results. And I can't come up with better reasoning than what I've laid out in this video, pretty much. Even though I don't know how the future is, it's all risk reward. It's just different scenarios, and looking at history and how people work, and yada yada yada. Anyway, consider me biased if I talked about any stocks. Assume they're sponsored sponsors, even though I don't think. Well, Western Alaska is a sponsor. Uh, yeah, hit the like button if you like this stuff. Thanks for listening, and stay cool, stay calm, stay collected. We're gonna do this. It doesn't matter what your past investing results are. The future is all that is left for us. So we'll have to do the most rational decisions we can, based on the current situation, not based on the past. Bye.